Hi everyone, welcome back to Corporate Decoder, where we take complex financial wizardry and turn it into something you can actually understand. Not to mention it feels like they might be playing a little shell game with their numbers this time around. Today we are diving deep into Darden Restaurants Inc.'s annual report, the 10K, for the fiscal year ending May 25, 2025. This is where a company lays it all out for investors and regulators, showing us exactly how they did over the past 12 months. Darden is the big boss behind popular restaurant chains like Olive Garden, Longhorn Steakhouse, Cheddar's Scratch Kitchen, and many others, the casual dining giants. They operate over 2,000 restaurants and also have a bunch of franchise locations. Let's jump right into the juicy numbers, starting with sales. Darden pulled in a massive $12.0767 billion in sales for fiscal 2025. That's a solid 6% increase compared to the previous year. What drove this growth, you ask? Well, a 2% increase in sales from their existing restaurants that were open for a while and the new restaurants they opened, including a big leap with the acquisition of Kai's. Now for the profit picture. Diluted net earnings per share from continuing operations hit 8.88 and from continuing operations also saw a 2% bump reaching $1.051 billion. They also had a small loss from discontinued operations, but overall it's a positive financial story for them. But here's where we need to dig in. While sales are up, their total operating costs and expenses also rose by 63% to $10.71444 billion. This means their profit margin on each dollar of sales didn't grow as much as their sales did. Their food and beverage costs went up 3.8%. They tried to explain this as pricing leverage and cost savings, but also admitted inflation played a role. It seems like they managed to pass some of those higher food bills onto us customers through menu price increases. Restaurant labor costs increased by 5.9%. Again, they mention inflation and productivity improvements. It's a constant balancing act in this industry, keeping staffing just right while managing rising wage pressures. Restaurant expenses like utility supplies and things like that went up 7.3%. This increase was partly blamed on inflation and the cost of integrating new brands like Chai's. Marketing expenses saw a bigger jump of 17.6%. This suggests they are investing more to get the word out about their brands and perhaps to compete more aggressively. General and administrative expenses, which cover things like corporate overhead, also rose by 8.6%. A notable chunk of this increase is tied to the Kai's acquisition and integration costs. Now, this line item is interesting. Impairments and disposal of assets jumped significantly to $49.2 million from $12.4 million. This is mainly because they decided to close 22 underperforming restaurants in the fourth quarter of fiscal 2025. Closing restaurants is tough, but sometimes necessary to cut losses and focus resources on where the business is doing well. Let's look at how their different brands performed. Olive Garden, the star of the show, reported a segment profit margin of 20.3%. That's a slight improvement, and these guys are bringing in a whopping $5.2129 billion in sales. Even with a slight dip in customer visits, their average bill went up, and that kept their profits healthy. Longhorn Steakhouse also showed strength with a segment profit margin of 19.3%. Their sales grew nicely, driven by both higher average checks and more customers visiting. They seem to be doing a lot right at Longhorn. The fine dining segment, which includes Ruth's Chris, the Capital Grille, and Eddie V's, saw a slight decrease in profit margin to 18.6%. While their average customer check stayed strong and even grew slightly, they saw a drop in customer numbers, which hurt their overall performance in this segment. It looks like even the fancy restaurants are feeling the pinch of customers dining out less often. The other business segment, which is a mixed bag of brands like Cheddar's Yard House and the newly acquired Chai's, had a segment profit margin of 15.7%. This segment also saw more customers, but with a slight decrease in average spending. The acquisition of Chai's, however, definitely boosted their overall sales in this category. With all these brands, Darden has to manage a complex operation. Their strategy seems to be focused on operational excellence and leveraging their scale to make each brand shine. They are constantly looking to open new restaurants while also keeping a close eye on the performance of their existing ones. Now let's talk about the risks. Darden is exposed to a lot of things that could go wrong. Inflation is a big one. They are worried about rising costs for food, labor, healthcare, and utilities. If they can't keep up with these costs or pass them on to customers, it could hurt their profits. They also mention the competitive labor market. It's tough to find and keep good employees, and that can lead to higher wages and other costs. Changes in minimum wage laws are a constant concern too. This is a critical point. Their whole business relies on having enough good people. If they can't hire or keep staff, it affects customer service and their ability to grow. They are also worried about employee turnover rates. And of course, health concerns are always on their mind. Any food-borne illness scare or even fears about diseases like the flu can make people stay home and eat out less. Social media also plays a big role here, amplifying any negative news very quickly. They also point out the intense competition, not just from other restaurants, but also from grocery stores offering prepared meals and delivery services. They need to stay on top of trends and keep their brands relevant. Social media is a double-edged sword for them. It's great for marketing, but one bad experience shared online can spread like wildfire and damage their reputation. Government regulations are also a major factor. They have to deal with all sorts of rules about health, safety, food labeling, and employment practices. Keeping up with all these different laws across various states is a challenge. They even touch on climate change and how severe weather can disrupt their operations or increase costs for supplies. Basically, Darden's success is tied to a lot of things they can't control, like the overall economy, consumer spending habits, and even the weather. They are trying their best to manage these risks, but it's a constant challenge. A significant part of their business model involves leasing properties, which means they have long-term lease obligations. If a restaurant doesn't do well, they can't just walk away from the lease easily. It's good to see that their board of directors is actively involved in overseeing these risks. They have committees dedicated to things like audit and compensation, making sure the company is run responsibly. Looking at their balance sheet, Darden has $937.7 million in current assets. That's up from last year, mainly because they have more cash. Good to see. However, their current liabilities are much higher at $2.25 billion. This increase is mostly due to more accounts payable, which means they owe suppliers more money and other current liabilities. Now let's put on our Warren Buffett hat and see what this all means. Darden is a giant in the casual dining space. They managed to grow their sales even with a slight slowdown in customer visits in some of their brands by increasing what each customer spends and by acquiring new brands like Chai's. That's a smart move to diversify and grow. Their profit margins are decent but not spectacular, and they are facing real cost pressures from inflation and labor. They seem to be handling these well by increasing prices and cutting costs where they can, like closing underperforming restaurants. The risks they highlight are pretty standard for a company of this size in the restaurant industry, but their sheer scale is a huge advantage they can negotiate under labor. They seem to be handling these well by increasing prices and cutting costs. Where they can, like closing underperforming restaurants, the risks they highlight are pretty standard for a company of this size in the restaurant industry, but their sheer scale is a huge advantage. They can negotiate better prices with suppliers and invest more in marketing. The key for them will be to keep their brands relevant and manage those rising costs effectively. Overall, Darden looks like a solid company, but we need to watch to see if they can continue to grow customer traffic while keeping costs. Alright, that's our deep dive into Darden Restaurants' latest annual report. What are your top takeaways from their financial performance and their strategy for the future? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate financial decoded content. And don't forget to join our Discord community linked in the description for more discussion and early access to our content. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.